So how do we figure out your income? It depends what you do for a living. If you're hourly versus salary versus commissions, tips, self-employment, we're going to break it all down for each one for you. All right. So the easiest one is salary. If you're going to salary, it's very easiest for us to use. We just take whatever your salary is, divide it by 12. That's your monthly income. Simple as that. Okay. We're going to get your pay stubs and for last 3 pay stubs and your last 2 years of W-2 forms. Okay. Those are the documents we're going to need. Now, if you are hourly, okay, same documents. We're going to get your last 3 pay stubs, 2 years of W-2 forms, and we may ask for your last end of year pay stub so we can see how much hours you worked last year. All right, a lot of people who are hourly, they get raises every year. So we need to see how much you were making last year versus how much you were making this year so we can try to maximize your income, give you as much as possible based on your new income.
Then depends if you're a self-employed person. So if you're self-employed, there's a different way we look at your income. We're going to get a copy of your most recent tax returns, typically the most 2 years of recent tax returns. And what we do is we're showing how much of actual profit that you make. So I talk to business owners all the time. I ask how much they make. Every single time they tell me what their total revenue was for the year. Now your revenue is how much in sales you have coming in. But we have to factor in all the expenses. So when you're running a business, there's payroll, there's marketing, there's cars, there's so many different things that go into running a business. And as a lender, we care about what you have at the end of the day. So your revenue minus your expenses is your profit. And that's the figure that we're using when qualifying you for a loan. Now, there's other programs out there that look at how much total revenue you have coming in over a 12-month period, and we can get you approved that way. But those loans require 20% down. They have higher fees, higher closing costs, higher rates. So we try to avoid them when we can. And that's why we like to do the traditional qualifying method, which is where we're looking at your tax returns. So one big thing is if you are thinking about buying a home and you're self-employed, you definitely want to consult one of us, talk to a lender, and we can help come up with a plan with you, yourself, your accountant to make sure you're going to be on track to buy a home. I see it all the time. Someone wants to buy a home and they get us a copy of their tax returns and they realize, oh crap, I didn't show enough income on paper. And then we're kind of scrambling to figure out how do we get you and your family into this home and make the numbers work.
Yep. So that's a good time right now to talk about a cosigner. If we have a cosigner, they can be added to the loan. We look at their income and debt, and now it's the self-employed borrower, let's say, plus another person's income and debt combined. And that's how we get more income and qualify for more of a loan. So cosigners are huge. We see that on a lot of loans nowadays that people need more than one person to qualify. It's a lot harder to qualify than it used to be.
And talking more about income, the biggest thing we're looking for is consistency. We need to show that you have the ability to repay the loan. Because if our company is lending out hundreds of thousands of dollars, we need to make sure that you're a credit-worthy person who has the proper income to pay back the mortgage on time. So changing jobs is a big issue, or can be a big issue, when going for a mortgage.
No.
And the reason for that is when you change jobs, we don't know how that new job is going to work out for you most of the time. Now, if you're a salaried employee, it's easy. We know that every single pay period, you're getting that same amount of money. So there's no red flags there. Easy. We can get you approved right away. When you're moving to a new hourly position, a new commission-based position, new pay structures, that's when it can be problematic because we need to show how many hours you're going to be working. We live in South Jersey. It's a big seasonal market. So a lot of these jobs, you work more in the summer than you do in the winter. So when people get this new job and they've been there for a month, we need to make sure that 6 months from now, a year from now, they're going to still be getting consistent hours.
So especially like Greg was saying, the commission people, tipped borrowers, someone like that, we usually going to need you on your job for at least a year. Okay, so we can see that you are consistent in your income and that you're going to be able to afford the mortgage payment. Okay, we don't want you to be based on the top part of the year and then in the winter you can't afford it. So that's why we're these rules are in place to make sure you're able to afford the mortgage payment at the end of the day.
And this might be a hot take, but I think the mortgage rules, I think they're more than lenient. I can't tell you how many times I see borrowers, they stretch themselves to the absolute maximum debt to income ratio that's allowed. So like we said before, you can go up to about 50% of your debt to income. So your gross monthly income compared to your gross monthly debt. Now, if you're maxing yourself out and there's no other income coming in and there's nothing that's going on behind the scenes that we don't know about, it's gonna be tough to live. You have to remember, there's utility bills, there's groceries, there's going out to dinner, there's hanging out with friends, there's all the other things in life that come up. And it's just gonna be tough because when you own a home, things happen. You might need a new HVAC system, your refrigerator might go, your roof might have an issue. So these are things that people need to be ready for, need to budget for, and if you're maxing yourself out to the max debt to income ratio, it's gonna be tough to save any money.
So if you're on a commission or tipped income, similar to if you're hourly or salary, we're gonna get your last 3 paychecks, last 2 years of W-2 forms, and we may ask you for your end of year pay stub from the year before so that we can see the breakdown of your commission versus salary versus tips so that we know, okay, this is how much they're getting and come up with an idea for an average of their income.